It's now with a look at the markets. Stephanie Link, Hightower Chief Investment Strategist and a portfolio manager. And Stephanie, initially I thought you were kind of messing with us a little bit because right at the top it says that she's really, really excited about earnings season is here, exclamation point. I'm so excited. Yep. I'm like, that's nice that you're playing along with our promos and everything because we're trying to get really excited too, but you have a reason for it. You don't. Finally, you're going to get a break from talking about the Fed and macro stuff.
Yes.
And delve into the minutia of earnings, and you're welcoming that.
I'm very excited for earnings, Joe. I do not want to talk about the Fed.
You're very excited.
I don't want to talk about
promos. Get you excited?
I am.
Is that what did it? You watch our promos and you go, "Oh my God, honey, get in here! It's earnings season." Okay.
Yes.
Which
earnings
one?
season, it's going to be good. It's going to be good. It's going to be good. We're off to a very good start with JP Morgan and Wells Fargo. So I added actually Wells Fargo into my portfolio on Friday.
You did?
Because I think the banks are actually set up really well. They had very good credit quality. Wells Fargo actually saw a decline in commercial real estate net charge-offs, which that gets me excited, right? I mean, that's the thing that has been bothering me about even the regional banks in general. So they had very good credit quality. So did JP Morgan. They're both talking about a trough in net interest income. So we have to wait for them to see the results in net interest income, probably until 2025. But in the meantime, non-interest income, meaning investment banking, wealth management, credit cards, capital markets, all are actually doing better than expected. And both companies actually are taking share, which I think is a positive. And Wells Fargo trades at 1.3 times book. And we have the asset cap removal potentially coming in the next couple of months. It's been since 2017 that they've had these this restriction on asset cap for a while. So I think you're going to start to see a resolution there, and that should be a nice catalyst. So I like the banks. I think they're set up pretty well.
And we're in the end game of Basel III, so eventually they'll be able to return to more normal. And if Wells Fargo can do it, then some of the other names can definitely do it, I guess, that haven't reported yet.
That's for sure. That's for sure. And I like Truist on the same theme, where it's kind of a self-help. They're doing all that they can while they wait for the big bulk of their business, net interest income, to improve, as I mentioned. And so we got some visibility or clarity on when we're going to see net interest income improve. And that's good for Truist because that's 70% of their total revenues. In the meantime, the last 2 years, Truist has actually cut costs. They're focusing on trying to gain some market share. They're investing to grow in the future. And 2025 is a good setup for them because profitability should improve. And in the meantime, they have a $5 billion buyback. And so, again, Basel III endgame, when we get that resolution, we will start to see a pickup in the buybacks as well.
What besides the banks do you like? Crowd?
Yeah. I do. I like CrowdStrike. I mean, I know it's recovered nicely since it fell 41% since the software glitch, but it's still down 18%, Joe, from its highs. And it's like the #1 company in the industry, and it is definitely on sale. And I know it's not cheap from a PE basis, but when you can get the #1 company with the #1 product in a cybersecurity, which is one of the #1 themes in technology that I like, I think it's set up really well. What was interesting with their quarter was in the face of the software glitch, they had a 98% retention rate, which is really pretty important, right? Because a lot of people thought the glitch would mean companies would leave CrowdStrike to go elsewhere, and they're not. So you got a company that's growing 40% on earnings and 30% in revenues, and subscription revenues are up 33%. So I think that one is definitely still very attractive, even though it has had a nice little bounce from its lows.
Chipotle is down a little bit from its highs also, so you'd buy that.
Yeah. I like Chipotle. This is the same theme. It's #1 in the industry. I think the numbers have been de-risked. You know, they did lower their same-store sales numbers a couple of months ago to about 6.1%. Gross margins are not going to expand as much as people expected because they're not taking the price increases that they have been over the last couple of years. But they're still going to grow nicely, double digits in terms of earnings and revenues. And I know everyone's nervous that Brian Niccol left as the CEO, but they have a very strong bench, a great team, and I think they're going to continue to do well. So, yeah, down 15% from its highs, too.
And I think we have time for one more. You like Gap?
I do like Gap, and I've never owned Gap before, but I do think that the company has done a really good job in terms of cutting their inventories. Gross margins are expanding. You have Richard Dixon is the CEO. He's been there since late 2023. Sometimes it takes a couple of months, quarters for a new CEO to really gain momentum, and I think he actually is, and he's hired a new CEO of Athleta, a new CEO of Old Navy. So I think you're going to have a good product refresh. And again, inventories are down nicely, so they're not going to have to mark down. I don't think they're not going to have to. And I think as a result, you're going to see better gross margin. Stock's trading at 12 times earnings with a 3% dividend yield. So yeah, I like that one a lot.
And quite a bit from its highs too, down about 25% or so.
Yeah. So, I mean, I'm just trying to find things that are down, that are not out, but maybe they're forgotten for the time being. And I think all three of those names set up pretty well into earnings. I don't want to chase. You don't need to chase in this market.
Would I ruin your day if I ask you about a 4.1% 10 years? Or in your view, could that get at all dicey if numbers stay strong in the economy and maybe there's a reverse pause, a pause coming down instead of the pause that we saw going up?
Well, you know what? I'll take higher growth, a little bit higher inflation, and a little higher interest rates any day, Joe.
Really? Not
good.
all traders
Rates are going.
Most of them are ready to mainline the free money.
I know. But I mean, look, at the end of the day, we're growing at 2.5%, 3% in the economy. We should cheer that. And so rates could easily stay at this 4% level. I think we can handle it, Joe. I mean, we have handled higher interest rates because we do have a lot of stimulus in the system. The consumer is still really strong, and they're spending. Remember, retail sales got revised higher last month. Manufacturing, we're seeing a renaissance there because of onshoring and reshoring. So I don't like higher rates, but I can deal with it if the reason that we're seeing higher rates is because we're seeing better growth.